What's up, people? I'm Wale Ogunleye, head of sports and entertainment at UBS. But before that, I spent 11 years in the NFL tackling quarterbacks. Today, I have the privilege of helping hundreds of athletes and entertainers grow their businesses and investment portfolios. Welcome to Level Up, where we explore different financial literacy topics to equip you with the knowledge you need to be financially fit. Let's get started. On today's episode of Level Up, we discuss investing, the art of legacy, and how you can establish and prioritize long-term goals.
I think people achieve their long-term financial goals by being really diverse in their revenue streams. I think different ways to manage your finances really help you, and I think really sticking to like a budget is helpful.
On the 6th episode of Level Up, Investing, the art of legacy, we welcome the presence of Hunter Greene.
Welcome to the big leagues, Hunter Greene.
Hunter Greene is an MLB pitcher for the Cincinnati Reds who was selected second in the 2017 MLB draft.
When did you start investing and why?
The first time I realized I had to invest would have been years before I was drafted.
The Cincinnati Reds select Hunter Greene.
My family constantly talked about how expensive it is living in Los Angeles, where I'm from, and just being smart when that time came, being drafted and where I was going to move to, where I was going to establish residency. And so yeah, I'd probably say like 12, 13 years old, we were already talking about it. That was already in discussion.
Unfortunately, I started investing probably way before I should have. I listened to teammates, people who I thought were experts in money just because they had money. Again, I wanted to be smart. I wanted to win. I had a competitive nature. I should have waited until I understood exactly what investing was. And that didn't happen until I went back to school and get my education. For more insight on why exactly this happens, let's hear from one of our advisors at UBS, Mike Singh.
Before we talk about how investing fights inflation, we first need to understand the difference between just saving your money and investing your money. Saving is simply when you set money aside, usually in a savings account, savings bond, or even a checking account. Although keeping money in a savings account is extremely safe, that money can't grow at a large rate over time. With investing, you're actually purchasing a financial product like stocks or bonds, mutual funds or ETFs, or even real estate. These are all types of assets. When you buy an asset, there may be a potential for generating return, which means your asset might make money, but there's a risk that it may lose value, especially over the short term. There is something called compounding, which is the ability of investment earnings to generate their own earnings and so on. The beauty of compounding is that the longer your money is invested, the more money you'll earn over time.
Wale, what was your first investment?
My first investment was in a friend's business, and that business went bankrupt pretty quick. So that was a failed investment.
For me, I have an endowment as well, a scholarship at my high school, Notre Dame High School in Sherman Oaks. I founded my endowment with my own money as well as endorsement opportunities. My goal is to have a 15, 20-year career. Even if I have a 15 or 20-year career, I'm still going to be alive for another 40 years. The game I grew up playing provided me that platform to be able to inspire the next generation of players, and that's what I plan to do with my endowment. This is my legacy.
My first investment was Disney. And so my principle the whole way through has been really investing in something you believe in.
Did you know there are many different ways to invest? Investing is not a one-size-fits-all model. It can look different for everyone depending on your tolerance for risk and time horizon. There are three main types of asset classes. Stocks provide part ownership in a company. For example, let's say you buy stock in Beyond Meat because you think the company will do very well. If they do, your stock price will likely increase so your investment grows. The S&P 500 is a stock market index that tracks the largest 500 companies. It represents the stock market's performance by reporting the risks and returns of the biggest companies. Investors use it as the benchmark of the overall market to which all other investments are compared. Bonds are the most common form of fixed income securities. Fixed income means the asset will generate constant cash flow. You might get paid quarterly or semi-annual distributions, but the income is always steady. Companies raise capital by issuing fixed income products to investors. A bond is an investment product that is issued by corporations and governments to raise funds to finance projects and fund operations. Cash includes legal tender, bills, coins, checks received but not deposited, and checking and savings accounts. Cash equivalents are any short-term investment securities with maturity periods of 90 days or less. They include bank certificates of deposit, bankers' acceptance, treasury bills, commercial paper, and other money market instruments. These assets can be converted into cash immediately. Historically, stocks have risen in value more than bonds or cash, but they also carry the most risk of decreasing in value or volatility, particularly over the short term.
My favorite part of the show. Let's head to the street for the question of the day.
Wale, are you okay losing money when you invest, and would you know when to cut your losses?
With all these different types of investments available, it's important to remember you're in this for the long haul. It's about setting long-term goals and going with what's best for you. For reference, 94% of the time, the S&P 500 is positive over a 10-year period. That can mean more money in your pocket than what you started with. On this episode of Level Up, we discussed investing, the art of legacy. Listen, my first investment wasn't a good one. But I hope you now see the importance of surrounding yourself with the right advisors or financial planners within your ecosystem that can help you build your legacy. You, as an individual, can set long-term goals by visualizing your ideal future, maybe create a vision board. Write SMART goals. Prioritize your goals. Make a plan to track your goals or have someone that can be your accountability partner. Thank you for joining us. We'll see you next time.